Welcome to this Killik Explains finance video. This week, are stock market investors following the right numbers? In other words, benchmarks are used everywhere in investing. Have you got the right one? Interesting question. Show you what I mean. So, what's the background to this one? Basically, the UK equity market has been a good source of return. So, because these videos tend to go to UK investors in the main, that's the market I'm going to pick on, but I'll mention some other ones a bit later on. So, great, but how good? In other words, when you say the UK market's been a good source of returns, UK equity's done well, past is no guide to the future, of course. You can lose money in shares as well as make it, all those caveats apply, but it has been historically a good source of returns, but how good? And that depends on which number you choose to follow. And that's really important because if you've got a portfolio made up of UK equities or made up partly of UK equities, you need to pick something to measure it against. So you can say, well, I've done well. What does that mean? Better than what? Or I'm not underperforming what? And that's the point I'm trying to make here. Selection is important, and the obvious benchmarks are not always the best. Now, what should a good benchmark offer you? Well, I'd say three things. The right focus. In other words, if you're running a portfolio, you've got a portfolio of stocks, whatever benchmark you choose needs to mirror what it is you're trying to measure. Obvious point, but easier said than done sometimes. It needs to use the right measurement. What do I mean by that? Come back to this. But if you are basically running a portfolio of 15 stocks, for argument's sake, with even amounts in each stock, then a market capitalization weighted index won't give you an exact replica benchmark because you're using different measurement techniques for each part and a decent track record. So you need something which is reasonably well established that investors are reasonably confident and comfortable with. Some parts of the world, those are widely available from more than one source. In other parts of the market, they're not. So you need to look at the benchmark quite carefully before you decide whether it's going to be useful to you. Now, this is one I've talked about before, so I won't hammer it. The Footsie 100, quoted by the press all the time in the UK, seen as one of the best tested, most robust benchmarks for UK stocks. But actually, although it tracks the market capitalisation of the top 100 firms in the UK, so it sounds quite comprehensive, and it is still widely quoted by the media, and it's used as a benchmark as well, there are reasons to be wary. Now, I've covered these before, so I'm going to go through them fairly quickly and then get on to some thoughts about an alternative. So, it only covers 100 companies, including many international ones. So if you are purely looking at the UK market, increasingly, this is not a UK-focused index. It has a lot of earnings that are being generated elsewhere than the UK. Secondly, it doesn't include income. Now that is a more comprehensive failing, arguably. If you are looking at the return you're getting on an asset, and I'd say property is the same as shares, you should really be looking at the total return. To ignore income is, in a lot of cases, a bit misleading. And it's not the only asset class where that's the case. And is there therefore something better? Well, as it happens, there is. Now remember my three tests to make a benchmark worth using. So there is the Footsie All-Share Total Return Index. Not as easy to say, not as good for headline writers as Footsie 100, but I would argue a better bet for long-term, stress, long-term equity investors. So All-Share, clue in the name, total return, another clue as to where we're going with this. Now this time, it's a much wider universe of firms. Not surprisingly, All-Share suggests there's more than 100 in the index, and there's a lot more than 100. Over 30 years of data is now available, so the criticism you could have levelled at this, that there wasn't really a decent track record, is no longer appropriate, I would suggest in most cases, and it uses total returns. Income plus capital. Reinvested income plus capital. And that, for any investor, property, shares, you name it, is important. Without that, you are missing a key part of the picture. So what is total return? Quick reminder coming up, have covered it elsewhere. Capital appreciation plus reinvested income. In other words, you don't draw dividends out, you recycle them back into your underlying investment portfolio. Relevant to anyone taking a long-term view and not withdrawing income. Now clearly if you're at the point where you're having to draw income off a portfolio, then you can argue that looking at total returns as a growth metric won't work because the income isn't being returned to grow. But if you are building, let's say, for a fund for life after work, all right, building towards peak savings, then this is very relevant indeed. So it's a key metric for comparison. And anyone saying, shares versus property, well, you need to be looking at the total return on property. I'm not sure if such an index exists, not just capital appreciation, which is only one part of the picture. Now, were we to do a side-by-side snapshot, so a price-only Footsie all-share comparison to total return Footsie all-share, what do we notice? A couple of things. So here they are side by side. Pink is price only, capital appreciation only. This is the all-share, bear in mind. Green, total return. You notice a couple of things. One, the line taking you from left to right for the total return index is less bumpy. All right? Now, it may not look a lot less bumpy, but it is less bumpy. Reinvesting income tends to smooth maximum drawdowns over time. It sort of cushions, if you like, to a degree, the portfolio against downsides. So that's quite important. But also, if you can read the numbers, which you may not be able to, you'll see that on the left we've gone from 0, and on the right we've gone from 0, but actually we've travelled a lot further in terms of gains and returns on the right than the left. So naturally, total returns, including income, add substantially to the long-term overall picture in terms of performance. And that's really important. There have been studies to show that since 1925, in the US stock market, up to half your total returns come from the reinvestment of income, and it's a really bad shortcut not to bear that in mind as an investor. Now, said we shouldn't just focus on the UK, even though this video will be being watched by quite a few people who have UK exposures, at least in part. What about other benchmark challenges? So if you're looking around the world, trying to find the right benchmark, the right index, what are you up against? You need something that's got the right sector weighting. I've seen countless benchmarks that will claim to be Asia, ex-Japan. When you look under the bonnet, thinking, well, I've got a broad exposure to many sectors, it turns out you haven't. You've got a substantial exposure to financials, for example, and not a lot else in some cases. So have I got the right sector weighting? If I'm looking at a technology index, does it give me a benchmark that's relevant to my portfolio and the weighting of technology in that or not? Use of market capitalization. Now, most indices, with a couple of exceptions around the world, do use market capitalization. That is, they use size to drive what's in the index and who's in the index. But if you're running a portfolio where stuff's evenly weighted, you're not going to get a meaningful benchmark necessarily. So just bear that in mind. In other words, is the benchmark weighted the same way as my portfolio? And thirdly, geographic coverage. Again, if you're an international investor, you need to look under the bonnet, say, is the benchmark I'm trying to use, and there are many, MSCI, global indices, for example, is it giving me a snapshot that reflects what I've actually invested in? Now, sometimes there's no right answer, but it is a question that's well worth asking. Don't just accept the first benchmark that comes along. Conclusions, therefore. Investors do want to know how well they're doing. It's natural to look for numbers that give you some guidance on that. Choice of benchmark is therefore important, but long-term investors need to choose carefully. Am I capturing total returns? Am I capturing a wide enough sample of companies? And have I got the weightings and so on right to reflect what I'm actually up to? Any questions? editor@killik.com. If you want to watch videos exploring things like total return and income in more detail, then it's killik.com/learn and hit the shares tab up on this side.